For a growing number of Americans, the issue is not that life has fallen apart suddenly. It is that life no longer feels secure in the way it once did. Individuals may still hold jobs. Earnings may still arrive regularly. On the surface, nothing appears severely wrong. However, month after month, it becomes more difficult to remain at ease. Bills occupy a larger portion of the budget. Credit card balances do not decrease as easily. Unexpected costs do not merely irritate anymore. They require difficult choices. That separation explains why this period feels so unclear. People continue to hear that the economy remains strong. Growth continues to be positive, jobs remain available. Yet personal experience presents another picture. For many families, the strain does not arise from job loss or abrupt decline. It arises from the gradual reduction of financial ease. This is not a tale of poor choices. Most individuals did not suddenly alter their way of living. What altered were the expenses surrounding them. Housing remained costly. Insurance increased. Healthcare expenses rose steadily. Food and utilities never truly returned to lower levels. Over time, those rises transformed ordinary budgets into restricted ones. What appears now is the following stage of that change. People do not surrender everything immediately. They adjust silently, extending payments, relying on credit, and determining which responsibilities matter most each month. Those selections do not appear quickly in news reports, but they indicate a profound change in family finances. This explanation aims to clarify that change. Household debt has grown so common in American life that it no longer seems worrying by itself. Mortgages, car loans, credit cards, these elements have existed for many years. What has shifted is not the existence of debt, but the purpose it now serves in daily existence. Total household debt has achieved record amounts. Yet that report overlooks the true concern. The concern is not that Americans abruptly accepted debt without care. The concern is that debt has moved from a tool people employed to create a better life into a tool people now employ to preserve one. In past times, borrowing usually came after income increases. A salary rise arrived first. A home improvement or large purchase followed afterward. Today, that sequence has reversed for many families. Expenses advance first. Income tries to keep pace. That covers the difference. Credit cards provide the clearest illustration. They once served as a short-term convenience, used briefly and cleared rapidly. Now, for many families, they act as a release mechanism. When groceries cost more, when insurance fees rise, when a medical expense appears, the card takes the impact. Not because people desire this, but because no other option exists for that expense. This applies especially to families that would normally be viewed as secure. Middle-income families often do not receive aid, yet they encounter many of the same increasing expenses. Over time, savings accumulated in previous years have been used up. What takes the place of those savings is not fresh income, but ongoing balances. The risk here is not abrupt failure, it is reliance. When debt becomes part of regular spending, families lose freedom. Every dollar of income becomes partly assigned in advance not only to daily needs, but to interest and required payments linked to earlier choices. That reduces budget adaptability and makes errors costlier. This explains why household debt today seems unlike past patterns. It is not focused on risky investments or extras. It spreads across ordinary existence. And systems built with narrow room do not fail right away. They experience quiet tension until a minor event moves them beyond their capacity. One of the largest shifts in family finances over recent years is not something most individuals monitor directly. It is not one specific bill or one specific figure. It is the loss of financial cushion. Financial cushion is the gap between managing and slipping backward. It is the additional money remaining at the end of the month. It is the savings account that can handle a surprise. For a long period, many families possessed some form of that cushion, even if it was modest. A vehicle repair did not instantly cause worry. A larger utility bill did not demand sacrifices. That protection made daily life feel controllable. Today, that protection has reduced or disappeared for an increasing number of people. The cause is not extreme spending. It is that required expenses have silently grown. Housing claims a greater share of earnings than before. Insurance fees for home, auto, health have increased and remained high. Medical expenses are less foreseeable. Even basic needs now take a bigger part of monthly earnings. When required expenses grow, cushion shrinks. And when cushion vanishes, freedom disappears too. That is when minor issues turn major. A dental appointment is not just awkward, it affects the entire month. A late paycheck starts a series of problems. One surprise bill causes another bill to delay. The family is not collapsing, it is managing multiple demands. This is the point where financial worry appears in actions. Even if everything still seems normal externally, people do not end everything suddenly. They delay. They move balances around. They depend more on credit. They promise themselves they will recover next month. Sometimes they succeed, sometimes they fail. The absence of cushion is what changes typical families into vulnerable ones. Not vulnerable in terms of immediate breakdown, but vulnerable in that they can no longer handle surprises without results. And when enough families arrive at that stage, the wider economy starts to notice. Not through major reports, but through trends that occur silently across millions of lives. That forms the connection between increasing debt and future developments. Late payments do not occur when people stop trying. They occur when people begin selecting. A missed or delayed payment is seldom the initial sign of difficulty, but it is often the first clear one. By the time a family falls behind on a bill, numerous silent changes have already taken place privately. Spending has been reduced, savings have been used, credit has been depended upon. Only then does something finally fall behind. This explains why late payments matter more than extreme figures like bankruptcies or home losses. They reveal tension while people still attempt to maintain control. Most families follow the same order when funds become limited. Housing ranks first. Rent or mortgage payments receive protection as long as possible. Utilities come next. Food cannot be compromised. What receives delay are the items with greatest flexibility. Credit cards, personal loans, sometimes vehicle payments. These are not choices made without thought. They are choices made to keep life operating. What has altered lately is how common this action has become. Late payment rates have increased across various types, not because people abruptly lost responsibility, but because more families have arrived at the limit of their financial cushion simultaneously. And this pattern no longer limits itself to the lowest earnings groups. Middle-income families, individuals who remain employed and earning, are increasingly involved. That represents a significant change. When late payments remain separate, the system handles them without issue. Lenders adapt. Credit ratings decline. Life continues. But when late payments expand, they signal that family finances face shared pressure. It means people make sacrifices they did not need before. Historically, this trend appears before wider economic weakness becomes clear. Jobs can stay steady for a time. Spending can persist, though more carefully. But below that appearance, the base weakens. Late payments are not the crisis. They serve as the alert. They indicate that the financial system no longer operates with ease or surplus. It operates on selection. And when millions of families enter that state together, the results do not remain limited. They spread outward gradually, but steadily. For many families, financial worry did not arrive from one major event. It arrived from past responsibilities returning at the worst moment. Student loans offer a clear case. For years, those payments paused or lowered. Families adjusted around that break. Budgets changed. Other costs grew to occupy the space. When student loan payments returned, they did not come as a fresh expense. They came as proof that the cushion people believed existed had already vanished. For some borrowers, the monthly sum was not even large. But timing is important. When budgets already feel restricted, adding even a few $100s monthly demands changes elsewhere. The outcome is not always failure on student loans directly. It is tension that appears elsewhere: credit cards, savings, or postponed payments. Auto loans have taken a similar course. Vehicle prices increased sharply and never fully declined. Interest rates rose, monthly payments expanded. For families that require a car for work, transportation is essential. The payment becomes required even as other factors grow less certain. What makes this mix risky is not the scale of any one responsibility, but how they combine. A student loan payment in one area, a larger car payment in another, insurance fees increasing quietly. None alone defeats a family. Together, they squeeze the budget until freedom disappears entirely. This is how tension spreads without notice. One bill does not delay because it lacks importance. It delays because another item received priority. And that selection grows harder as more required costs compete for the same limited earnings. These returning tensions also explain why late payments can increase even while jobs remain fairly steady. People work, they earn, but they carry more responsibilities than their earnings can easily handle. When earlier debts return to a financial situation already changed by higher prices and rates, they do not simply add burden, they shift the equilibrium. And once that equilibrium moves, the effects appear in all areas. One reason the present situation feels so unclear is that the economic information most people receive does not match how life truly feels. Gross domestic product continues to rise. Consumer spending has not dropped sharply. From afar, the system appears workable, but movement is not the same as strength. GDP tracks how much money flows through the economy, not the source of that money or how lasting that flow is. When someone uses cash, GDP increases. When someone uses a credit card, GDP increases equally. When a bill uses borrowed funds or delayed plans, GDP still records it as growth. That difference matters more now than in many years. Over recent years, consumer spending has increasingly depended on credit rather than growing real earnings. Savings from before were spent. What replaced them was not better pay, but borrowing from elsewhere. Spending went on below the surface. The nature of that spending shifted. This explains why locations can seem active while families feel pressured. A busy restaurant does not reveal whether the meal used comfortable funds or added to future debt. A full shop does not show whether the purchase fit a secure budget or increased a rising balance. Those facts do not appear in the data. The American cost of living has changed in ways GDP does not record well. More earnings now go to necessities that do not enhance daily life: housing, insurance, healthcare, and basic needs. That leaves less space for optional spending unless families use credit to bridge the gap. So when spending finally reduces, it is not because people lose desire. It is because the support behind that spending grows harder to sustain. Credit limits reach maximum. Required payments increase. Lenders become stricter. The same spending that once aided growth begins to lessen. GDP does not drop in these times. It follows later. It shows what already occurred, not the tension building beneath. By the time it clearly slows, families have often felt the pressure for some time. That is why depending on basic growth figures can mislead. The economy may still advance, but many families do so with much less security than earlier. One of the most irritating aspects of the current setting is that inflation seems finished, yet life never became less expensive. Prices stopped increasing as quickly as before, but they did not decline. That difference affects families. What matters is not the speed of rise, it is the height. And the height of daily costs moved upward and remained there. Groceries did not return to former prices. Insurance fees did not decrease. Healthcare expenses did not lessen. Utilities did not reduce. Instead, they settled at a higher standard. That new standard silently reshaped monthly budgets, changing what once felt manageable into something far more restricted. At the same time, interest rates remained high. High rates were meant to be short-term, a method to control inflation. But as rates stayed elevated longer, they became part of everyday finances. Credit card balances grew costlier to maintain. Auto loans remained expensive. Home equity lines and personal loans lost usefulness. Even families that avoided fresh borrowing felt effects through larger required payments and fewer choices. This mix is what makes the present time feel unlike brief inflation periods in the past. When prices rise fast but then drop, families can recover. When prices rise and remain while borrowing costs stay high, the tension becomes lasting. It does not end with waiting. It requires change. For many Americans, that change has already occurred quietly. Spending patterns shifted, optional buys reduced. Savings additions slowed or ended. What did not shift were the required costs. Those remained fixed. That is why the pressure feels ongoing. It is not linked to one bill or one year. It is part of the structure people now live within. Every month begins nearer to the limit than before. Inflation ending higher and rates remaining elevated did not damage the economy suddenly. They altered the conditions under which families function. And once those conditions change, the tension does not vanish just because news shifts focus. It remains, guiding choices long after the first impact lessens. One question that arises often is why all this feels so immediate now, even though many basic changes began years earlier. The explanation involves something known as the delay effect. Economic policy does not affect families right away. When interest rates increase or financial terms tighten, the influence spreads gradually. It requires time for old loans to renew, for savings to deplete, and for higher costs to fully enter daily budgets. In early phases, people have protection. Mortgages stay at lower rates. Savings remain. Credit access has not narrowed yet. Life feels uneasy but controllable. That is why for a period it appeared the economy could handle higher rates without great harm. But protections do not endure forever. As time continues, loans renew. Credit card balances become costlier. Auto loans restart at higher rates. Savings that once softened impacts run out. What once provided temporary help quietly fades. That is when the delay effect appears, not in major reports, but in actions. People stop preparing for long-term buys. They pause before new commitments. They grow careful, not from negativity, but because experience shows their cushion is smaller than before. Companies notice that caution and respond, reducing growth plans and becoming conservative. This postponed reaction explains why the economy can seem strong for a long time and then suddenly appear weak. The harm is not instant, it builds up. Each month of restricted conditions adds slight more tension until the system reaches a stage where even minor events matter. By the time the delay effect fully appears, families have already changed in silent ways. They have altered daily habits. They have reduced hopes. They have accepted a new standard without always noticing. That is what makes this stage hard. The change occurs slowly, but once finished, no fast return exists. The tension does not burst, it remains. When people ask what follows, they often seek a clear turning point. Major decline, headline event, clear sign that conditions have worsened. But that seldom occurs in this part of an economic cycle. What is more probable is a gradual decline. Spending does not end, but it lessens. Families keep purchasing essentials while reducing anything extra. Companies see the shift not through alarm but through weaker demand and slower activity. Hiring grows careful. Job cuts occur but in small, uneven groups rather than suddenly. Credit plays a large part in this phase. Lenders grow selective. Rules tighten quietly. Limits do not always reduce immediately, but approvals become difficult. For families already extended, credit access grows unreliable exactly when needed most. This setting does not feel exciting, it feels exhausting. People postpone choices. They avoid new responsibilities. They concentrate on keeping things steady rather than expanding. That attitude spreads across millions of families. And when it does, economic progress slows even without an official crisis. The main idea is that this type of slowdown is not equal. Families with lower debt and steady expenses still have choices. They can change without serious effects. Families with high required costs and little cushion feel every change right away. That is why this time feels so varied. Some people seem okay, others experience ongoing pressure. Both situations can occur together even in the same economy. A gradual decline economy does not declare itself. It shows through actions. More care, fewer chances, and increasing emphasis on security over growth. And once that action becomes common, it usually lasts longer than many predict. If there is one main lesson from all this, it is that the financial pressure many Americans experience now is not imaginary, and it is not individual fault. This time results from higher costs, stricter financial terms, and years of change that quietly lowered family freedom. People did not abruptly begin poor choices. They adjusted to a setting that shifted quicker than their earnings could follow, recognizing that is important. When reports discuss growth or spending, it helps to recall what those figures miss. They miss how narrow cushions have become. They miss the sacrifices occurring privately. And they miss how much work it now requires to simply remain steady. This is not about fear or forecasting ruin. It is about understanding. Reducing debt brings greater freedom. Reducing required costs brings greater strength. Knowing the gap between surface calm and deeper tension helps people make calmer, more thoughtful decisions. Times like this reward care, patience, and clear thinking. They do not favor extremes, neither unfounded hope nor ongoing worry. If this explanation matches what you notice in your own life or nearby, you are not alone. And if you seek more clear, realistic analysis that centers on facts rather than reports, consider subscribing so you can remain informed without feeling overloaded.